Hello everyone, this is Professor Mihir Shah and I welcome you back to our video lectures on the subject International Finance for your PGDFM Semester 2 under University of Mumbai. In this video, we are basically going to learn about Module 2 of International Finance, and this video is going to be part 1 of your Module 2.
Okay, I hope you all have went through the first video which contained detail and topic relating to the very first module. An important topic to cover for your second semester for the paper International Finance. Now in this video we are going to be discussing topics related to module 2 and important topics of module 2 from the exam point of view. First, let us see the syllabus. Now, we have already completed module 1 in our first video where we spoke about the introduction of international monetary system, the history of international monetary system, the different exchange rate regime. Then we went through the euro currency, and lastly we have completed FERA and FEMA. Now in this particular video we are going to discuss about module 2. Now, Module 2 contains 3 topics. Number 1, it relates to introduction to factors impacting the exchange rate, in which there are various factors which includes inflation, interest rates, demand supply of foreign currency, economic environment, and many more. The second topic that is there in second module is purchasing power parity theory. Now, this is a very interesting topic. In this we'll be learning about what is purchasing power parity theory and what are the different types. Similarly, we have third topic in our second module, which is interest rate parity theory. Again, in this we'll be learning about what is this interest rate parity theory and what are the various types. The last two topics, the interest rate parity theory and the purchasing parity theory, are very interesting topics. And factors impacting, again, is a very simple topic. Now from this video, the following will be our learning outcome. Number 1, we'll be learning about what is foreign exchange, then what is foreign exchange market, and what are the factors that are impacting the exchange rate. That will be the first part what we'll be learning. Secondly, we'll be learning about purchasing power parity theory. It has two versions, which is the absolute version and the relative version. So we'll be learning about those two types also. And thirdly, we are going to learn about the interest rate parity theory, in which again there are two types. One is called as the covered interest rate and the second one is called as the uncovered interest rate parity theory. And lastly, we'll be going through the question bank, what are the important topics that you need to cover up for your second semester.
Now to brief it much more further, this part of the video, that is the first part of second module, will contain the first 3 topics, that is foreign exchange market, and factors impacting the foreign exchange rate. The second part of the second module will contain the remaining theories. So let us see what are the topics that we need to cover in this video, which is based on second module part 1.
So to start with the second module, the very first topic that we'll be going to learn is the introduction to factors impacting foreign exchange rate. Now we all know that the international trade requires exchange of currencies between multiple trading partners. So in order to have a better understanding of international trade, it is necessary to be familiar with the international payment system, how the payment system takes place between 2 or more nations. So what should be the value of one currency in terms of another has always been a challenging question for economists and policy makers. Now, a country's currency is used not only by its resident but also by foreign residents who wish to purchase the country's goods and services. So, if we take an example, let's say we are residing in India, and if we want to purchase something from US, we'll have to pay in their currency. So, USD is not only demanded by USA, but it is also demanded by other countries who need to purchase the goods and services from US. This brings us to the concept called as the exchange rate between different currencies. Now, the rate of exchange of a currency is its price in terms of another currency or a group of other currencies. So, rate of exchange is nothing but your currency when compared with another currency. Okay, so what is the price at which you all will be setting off or settling off? The rate of exchange of a currency is the measure of its external value that measures its purchasing power in terms of foreign goods and services. Now, it is an important variable through which a country's interdependence with the global economy can be measured and evaluated. Okay, now over $5 trillion are traded each day in foreign exchanges around the world, making it the largest and the most liquid of financial market. Foreign exchange, or we can also call it as the forex, is a stock market where currencies of other countries are purchased or sold. Foreign currency is the conversion rate of a country's currency into that of another country. Now, in a free economy, a country's currency is valued by demand or supply. A country's currency can be also linked to a currency like, say, the USD or to a basket of currencies. The currency can also be fixed by the country's government, and many countries peg their currency freely against currency of other countries. Now, these last 4 points were already discussed in module 1 on the different regimes of the foreign exchange. So, your currency can be either valued based on the demand and supply. It can either be linked to some currency. It can be either pegged to other currency or basket of currencies, or it can be fixed by a country's government. So this has already been discussed in the first module. Now let us discuss another important term, that is the foreign exchange market. Now, what is foreign exchange market? A foreign exchange market refers to buying foreign currencies with domestic currencies and selling foreign currencies for domestic currency. Thus, it is a market in which the claims to foreign money are bought and sold for domestic currency. Exporters sell foreign currency for domestic currencies, and importers buy foreign currencies with domestic currency. According to Ellsworth, a foreign exchange market comprises of all those institutions and individuals who buy and sell foreign exchange, which may be defined as foreign money or any liquid claims on foreign money. So, foreign exchange transactions result in inflow and outflow of foreign exchange. So in simple terms, foreign exchange market is nothing but a place where you buy foreign currency with the help of your domestic currency, and you sell foreign currency for domestic currency. Now we need to learn about what are the various functions of a foreign exchange market. Now, the foreign exchange market performs the following functions. Number 1, transfer of purchasing power or clearing function. Now, the basic function of foreign exchange market is to facilitate the conversion of one currency into another, that is payment between the exporter and the importer. Now, now let's say if you want to buy a product in United States, you need to have dollars in order to purchase their products. So in that case, foreign exchange market facilitate or helps you to transfer your purchasing power, whereby your domestic currencies will be converted into dollars, and then with the help of dollars you will be able to make the payment there. For example, Indian rupees is converted into US dollars and vice versa. So that's the example that I just went through. In performing the transfer function, variety of credit instruments are used, such as the telegraphic transfer, bank draft, and foreign bills. So these are the various instruments by which you can, transfer the purchasing power of one country to another. Now, the telegraphic transfer is the quickest method of transferring the purchasing power. So that was the first function of your foreign exchange market, that it acts as a transfer of purchasing power, or it acts as a clearing agent. The second function is the credit function. The foreign exchange market also provides credit to both national and international to promote foreign trade. Why is this credit function given? Because it is necessary at some time the international payment get delayed for 60 days or 90 days. Obviously, when foreign bills of exchange are used in international payment, a credit of about 3 months till their maturity is always required. So for example, let's say Mr. A can get his bill discounted with a foreign exchange bank in New York, and this bank will transfer the bill to his correspondent in India for collection of money from Mr. B after the stipulated time. The third function is the most important, that is the hedging function. A third function of foreign exchange market is to hedge foreign exchange risk. By hedging, we mean covering of foreign exchange risk arising out of the changes in exchange rate. Under this function, the foreign exchange market tries to protect the interests of the person dealing in the market from any unforeseen changes in the exchange rate. So, foreign exchange market basically keeps on fluctuating. The rates keeps on fluctuating very often. So in order to safeguard yourself from the fluctuation, you can go into hedging. The exchange rate under free market can go up and down. This can either bring gains or losses to the concerned party. Now, hedging guards the interests of both the exporter as well as the importer against any changes in the exchange rate. Lastly, hedging can be done either by means of spot exchange market or a forward exchange market involving a forward contract. Now, what do you mean by spot exchange market? Now, spot exchange means on the spot. So, if you have to pay Mr. Y an amount of, let's say, $1,000, so let's say you're going to pay that after 1 week, or let's say after 1 month. So after 1 month, whatever will be the rate prevailing in the market, at that rate, if you're going to pay them, then it is known as the spot exchange rate. However, after 1 month, you don't know what the rate will be. So let's say if at present the rate is $1 is equal to rupees 70. After 1 month, you don't know whether it will increase or decrease. So to be on a safer side, you will go into a forward contract stating that after 1 month you will be paying Mr. X an amount that will be equal to $1 equals to 71. Now after 1 month, even if the rate increases to 72, the person will be only paying $1 is equal to 71 as stated in the forward contract. So by this two method, hedging can be done, which helps you to safeguard the fluctuation. The the next topic that we need to go through is the dealers or participants in foreign exchange market. Now this particular section is divided into three parts. The first part will explain you what are the various dealers in foreign exchange market. The second part will talk about the different types of foreign exchange markets. And third, we'll talk about the Indian foreign market. So first, we'll go through the various dealers or participants in foreign exchange market. Now, the foreign exchange market needs dealers to facilitate. The foreign exchange market needs dealers to facilitate foreign exchange transactions. The bulk of foreign exchange transactions are dealt by the commercial banks and the financial institutions. RBI has also allowed private authorized dealers to deal with foreign exchange transactions, that is buying and selling foreign currency. So the main participants in foreign exchange markets are number one, the retail clients. The retail clients basically deals through commercial banks and authorized agents. They comprises of people, international investors, multinational corporation and others who need foreign exchange. So basically they're individual people or they can be companies or investors who require foreign exchange. Second are the commercial banks. Commercial banks carry out the buying and selling orders from their retail clients and of their own account. They deal with other commercial banks and also through foreign exchange brokers. So first are the retail clients. They take money from the commercial bank. So the commercial bank becomes the second most important participant in foreign exchange market. Next, we have the foreign exchange brokers. Now, each foreign exchange market center has some authorized brokers. The brokers, they act as intermediaries between the buyers and sellers. Mainly, they are banks. The commercial banks prefer brokers. Next, we have the central bank, or as you know as the RBI for India. Under floating exchange rate, the central bank does not interfere in exchange market. This is what we have already learned in the first module. But since 1973, most of the central bank intervened to buy and sell their currency to influence the rate at which currencies are traded. So central bank becomes a part, or so central bank also become an important participant in the foreign exchange market. Now from the above sources, the demand and supply generate, which in turn helps to determine the foreign exchange rate. Okay, now the next part is the types of foreign exchange market. Now foreign exchange market is of two types, basically the retail and the wholesale market. So first we'll discuss what is the retail market. The retail market is a secondary price maker. Here the travelers, tourists and people who are in need of foreign exchange for permitted small transaction exchange one currency for another. So retail markets are basically for those people who require foreign exchange in small amount. The wholesale market. The wholesale market is also called interbank market. The size of transaction in this market is very large. Dealers are highly professional and are primary price makers. The main participants are the commercial bank, business corporation and central banks. Multinational banks are mainly responsible for determining the exchange rate. So wholesale markets are basically for those who require huge amount of foreign exchange, and that can be in the way of commercial bank, business corporation and the central bank. And the other participants basically in the foreign exchange markets are the brokers. Brokers have more information and better knowledge of market. They provide information to banks about the prices at which there are buyers and sellers of a pair of currencies. They act as middlemen between the price maker. Second are the price takers. The price takers are those who buy foreign exchange which they require and sell what they earn at a price determined by the price determined by primary price makers. Now the third part under this particular topic was the Indian foreign exchange market. Now in India, the foreign exchange market is made up of three tiers. First, here the dealing takes place between the RBI and the authorized dealers. Second, the dealings takes place between the authorized dealers itself. And third, the authorized dealers deal with their corporate customers. The next topic now we'll be learning is the factors affecting or determining the foreign exchange rate. This is a very important topic. Now, the foreign exchange rate, or we call it as the forex rate, is one of the most important means through which a country's relative level of economic health is determined. So the foreign exchange rate can actually determine the level of economic health of a country. So one can conclude stating that if there is a good foreign exchange rate between a country, that country has a good economic background, a good political and good stable economic condition prevails in that country. Next, a country's foreign exchange rate provides a window to its economic stability, which is why it is constantly watched and analyzed. If you are thinking of sending or receiving money from overseas, you need to keep a keen eye on the currency exchange rate, as that rate keeps on changing quite frequently. The exchange rate is defined as the rate at which one country's currency may be converted into another. It may fluctuate daily with the changing market forces of demand and supply of currencies from one country to another. Now, for these reasons, when sending or receiving money internationally, it is important to understand what determines the exchange rate. Now, foreign currency transactions are performed every day by individuals, businesses, travelers at airports, online shoppers, importers, exporters, currency traders, and many more places. Every country on this planet has its own currency that can be purchased or sold for commerce or personal reason. The globalization has added millions of transactions to the currency market. Now, we are in an era where globalization exists, so each and every country trades with another internationally. So, foreign exchange is very important. Obviously, with this comes volatile fluctuations that occurs due to various reasons. Some of the reasons are listed below. Okay, now the very first factor that determine, or the very first factor that affects the foreign exchange market or the foreign exchange rate is inflation. Now, inflation is the rate of change in the price level of goods and services in the economy. Inflation rates variation in the market is one of the crucial factors that affects the exchange rate of a country. Now, inflation rate is nothing but change in the price level of a country. So if the price of a particular product increases or decreases, it will simultaneously have an impact on the foreign exchange rate. Practically, a country which has a continuous low inflation rate will have a stronger value of their currency compared to those countries with inflation rate high, with other factors being constant. So if you have a lower rate of inflation, stronger will be your currency and vice versa. So in countries where there is low rate of inflation, the market value of the goods and services in those countries will usually appreciate at a relatively slow rate compared to countries with higher inflation rate. So in a country where the rate of inflation is low, the market value of the goods that are and the services that are available there will increase, but gradually at a slower rate as compared to those countries which has a higher rate of inflation. The value of the currency appreciates steadily when the low inflation rates are experienced for a longer period of time. Whereas on the other hand, countries high on inflation rates for a prolonged period of time usually have interest rates high on goods and services offered, and at the same time experiences constant depreciation in the value of their currency. Next, the relative inflation rates of the two countries influences the exchange rate. Between India and US, let's say the exchange rate is rupees 70 is equal to 1 US dollar in a given year. So we are taking an example whereby the rate of exchange is $1 is equal to rupees 70. In the subsequent year, if the rate of inflation is higher in India than US, then the Indian goods and services will be costlier compared to US, where inflation rate is lower. So this is a common phenomena. If in India the inflation is higher as compared to US, the goods and services in India will be much costlier as compared to USA. There will be less demand for Indian goods and services from USA, thus reducing the supply of dollars. Whereas US's rate of inflation being low, there will be more demand from India for US goods and services. So now this causes an inverse relation. The situation results in more demand for dollars and at the same time less supply. Increased demand with the given supply or decrease in supply of dollars makes the dollar costlier. Let us say from rupees 70, now it has become to rupees 72. An opposite scenario would make the dollar cheaper. Thus, inflation is a very important factor that determines or affects the foreign exchange rate. The next factor that affects the foreign exchange rate is the interest rate. Now, interest rate, inflation rates and foreign exchange rates are always correlated and play a vital role in determining the stability of the market environment. Any slight changes in the rate of interest will definitely affect the value of the currency and its exchange rate in the foreign market. Interest rate to a currency has a dual impact on the currency valuation. If increase in the interest rate suggests the strength of the economy, then it would have favorable effect on the exchange rate. However, if there is increase in the interest rate due to expectation of higher inflation, then it would have an adverse effect on the value of currency. So interest rate also affects the determination of exchange rate, and it goes in dual way. Okay, it has dual impact. If the interest rate is increased due to the strength of the economy, then it is known as a favorable effect. However, if it will be increasing, or if there is an increase in the interest rate due to expectation of higher inflation, then it would have a very adverse effect on the value of the currency. Now, there are always two currencies involved in an exchange rate. Therefore, there might be situation where the interest rates of both the currencies may rise at the same time. Now, in such situation, the interest rate differential is obvious. Sometimes the smallest rate of the two currency could move in opposite direction, resulting in widening the gap between the two. In such cases, the effect on the exchange rate would be more distinct. Now, a higher rate of interest in India will attract foreign money to India to take advantage of the interest differential. Larger inflow of say dollar or euro would increase their supply and make them cheaper against rupees. However, it should be noted that investors consider the differential in real interest rate, that is the nominal rate of interest minus the rate of inflation. Okay, now to understand this, let us take an example. Let us take an example to illustrate how interest rate affects the exchange rate. Assume that there are two countries A and B. Both countries do not exercise foreign exchange control and capital funds can flow freely between them. So there is no restriction, basically what is meant by this particular statement. Now, as a part of its monetary policy, country A raises its interest rate by 1%, while the interest rate of country B remains unchanged. Now, there is a huge volume of liquid capital in the market that flows freely between these two countries, seeking out the best possible interest rate. With all other conditions remaining unchanged, as country A's key interest rate rises, a large proportion of liquid capital will flow into country A. When the liquid capital flow out of country B to country A large amount of country B's currency will be sold in exchange for country A's currency. In this way, the demand for country A currency will increase, strengthening it against country B's currency. So with this particular example, it becomes clear that interest rate, yes, it affects and it helps in determining the exchange rate. Now, if the interest rates are higher in say the US than in other countries, then investors will choose to invest in the US, increasing the demand for dollars, provided that the expected rate of inflation is not higher in US than among the other trading partners. If interest rates are lower in the US than in other countries, investors will choose not to invest in the US, decreasing the demand for dollars. If the US inflation rate is higher, investors are less likely to prefer the US even with higher interest rate because of the expectation that the value of the dollar will be eroded by inflation. Thus, one can conclude that interest rate is a factor that can affect the foreign exchange rate. Okay, the next factor that determines the foreign exchange rate is the economic growth. It states that higher economic growth rate will attract foreign capital to that country. China, which enjoyed the higher economic growth, attracted more foreign investment than others. India, which enjoys a better growth rate than many other countries, has experienced rupee appreciating in recent years from 48.395 in 2002-2003 to rupees 44.411 in October 2010. So, if a country is having a very good economic growth, that country's currency always tries to appreciate. However, in June 2013, the exchange rate per dollar crossed rupees 60. On August 28, 2013, rupee dollar exchange rate was rupees 68.85, which reflected weak economic situation of India. Subsequently, the exchange rate settled around 65 rupees a dollar. At present, that is April 2020, the exchange rate has crossed rupees 71. Similarly, countries with poor economic performance experiences foreign capital moving out, thus making the domestic currency weaker. Thus, economic growth is one of the factors that affects the foreign exchange rate. The next factor is government debt. Government debt is an amount which is the total public or national debt owed by the government. So it's basically like a loan which the government has taken. A country with a large debt will get less foreign investment, which can lead to inflation. This in turn devalues the value of country's currency. The unpaid dues created by the central bank are always considered to be a liability in general and a public debt in specific. The bigger the debt, the less likely the government is able to get foreign capital. This will result in increased inflation in the country and thereby affects the foreign exchange rate. When the debts are too high, most of the investors will opt to trade their bonds. This will lead to a fall in the value of the current exchange rate. Thus, government debt does affect the foreign exchange rate. The next factor is the terms of trade. The terms of trade are the ratios of export prices to import prices of a country. This ratio affects the balance of payment. Now the terms of trade are favorable if the export prices are higher than the import prices, or when the export price rises at a faster rate than the import price. So in simple terms, it states that if you have more export than your import, the terms of trade turns out to be favorable for that country. The effect generates higher revenue for the country. The domestic currency therefore will have a higher demand and the local currency appreciates in value. All this leads to an increase in the value of exchange rate. The next is the balance of payment. A country's management towards maintaining balance between trade and the earnings got from foreign investment is a very crucial in determining the exchange rate. This information can be obtained in the current account of balance of payment, which contains the sum total of all transactions done by the government, including exports and imports. When the government spends more on import as compared to export earning, it will create a deficit in the current account. This kind of deficit causes reduction in the value of domestic currency, causing disequilibrium in the balance of payment. In such a situation, volatility and unpredictability of the exchange rate of the domestic currencies becomes highly noticeable. Thus, the deficit in the balance of payment have a great impact on the determination of the foreign exchange rate. Okay, the next factor that affects the exchange rate is political and other factors. Political instability coupled with poor economic performance, along with other factors like the social unrest, make people demand less of that country's currency. While on the other side, countries which enjoy a positive economic, social and political environment find their currencies are more in demand. So, a country where the political or the economic performance is very poor and there is a lot of social unrest, that country's currency will be demanded less as compared to those countries which have a positive economic, social and political environment. Politics in a country will always affect its economic performance. A country that experiences severe political unrest is always considered risky for foreign investors. This diverts the foreign investment to those countries that are politically stable, safe and sound. Trade agreements between countries attract more foreign investment, which leads to increased foreign capital. A country fixed with constant political unrest and political instability will attract a lot of uncertainty in the foreign market, leading to depreciation of the exchange rate for its own currency. The next factor is the economic recession. A recession in economic activity of a country will lead to decline in the interest rate. This will eventually reduce the chances of country to get foreign capital. This will eventually lead to the domestic currency becoming weak in relation to foreign countries and therefore decreasing the value of foreign exchange rate. The next factor is speculation. This is more of a sit and see approach of foreign exchange. More than 90% of the turnover in global foreign exchange market represent speculative activity. If the trader on his own instinct feels that in the near future a certain currency will increase in value, then he will buy that currency at the prevailing lower rate now. Then he will wait till the value increases so that he can sell it at more value than what he had bought it earlier. This eventually will increase the exchange rate. Thus, speculation plays a very important role in determining the exchange rate. The next factor which does have an impact on foreign exchange is the employment rate. The employment rate data released by each country is a fair barometer to measure the performance of its economy. A high rate of unemployment indicates stagnation of the economy and depreciation in the value of the currency. This leads to a dip in the foreign exchange rate of the currency of the given country. On the other hand, if the employment rate is good, that will indicate a higher performance of the economy, thus creating more inflow of foreign exchange. Okay, now the most important factor which surpasses all the other factors is the demand and supply for foreign exchange. Now to understand this, we will split up the term. We will first discuss the demand for foreign exchange and thereafter supply for foreign exchange. Now, first thing we're going to start with demand for foreign exchange. The demand for foreign exchange in a country is determined by a complex set of factors that are influenced by the country's level of development, growth rate, international trade and government policies. Some of the important factors that generate demand for foreign exchange are as follows. Number one, import of goods. This is the most important factor generating demand for foreign exchange in a country. Most countries import goods to meet domestic demand and to take advantage of cost differences with other countries. Countries trade in capital, intermediate, and consumer goods. With the lowering of trade barriers in the last few decades, there has been very significant increase in import of goods, particularly by emerging economies, resulting in increased demand for foreign exchange. The price of imports and the demand for foreign exchange are inversely related. Elasticity of demand for import has a significant impact on the demand for foreign exchange for this purpose. If the demand for a country's major merchandise imports is price and income elastic, then the demand for foreign exchange is likely to be consistently high. Second is the import of services. Along with goods, countries import services. Import of services by many countries has increased manifolds after the creation of the World Trade Organization and the development of communication technology. Services that are imported by nations include tourism, transport, banking and insurance, communication, education, professional services, etc. So, import of services also influences the demand for foreign exchange. Third is the unilateral payments. These are payments from one country to another that do not correspond to the purchase of any goods, services, or assets. These include donations, gift, repatriations. Okay, that is nothing but the return of incomes like profit, dividend, interest, remittance sent by foreign workers working in reporting country, foreign aid, and assistance given by the government of a country to another country. So this also creates a demand for foreign exchange. Next is the export of capital. Capital leaves a country in various forms, resulting in demand for foreign exchange. Repayment of debts, purchase of asset by resident and government in foreign countries, investment in financial asset in foreign countries, foreign direct investment and lending of foreign nationals all generate demand for foreign exchange. Next is the future expectations. Since almost everywhere the foreign exchange rates are market determined, they change with changes in demand and supply. Hedgers demand foreign currencies in order to protect themselves from risk arising out of foreign exchange fluctuation, while speculation demand foreign exchange to make profit by selling the currencies at a higher rate in future. Both these activities generate demand for foreign exchange on the basis of future expectations. So now future expectation consists of hedgers and speculation, whereby one demands for foreign currency in order to protect himself from the future risk, while the other demand for foreign exchange to make profit by selling the currencies at a higher rate in future. Now the total demand for foreign exchange is inversely related to its price, that is the exchange rate. It means higher the rate, lower will be the demand, whereas lower the rate, higher will be the demand. Now this can be understood with the help of the following diagram, where OX on the x-axis we have demand for foreign exchange and on the y we have foreign exchange rate. The demand curve, like an ordinary demand curve, is sloping downward from left to right and shows an inverse relationship between the price of foreign exchange in domestic currency and the demand for it. At the rate OR per unit of foreign currency, OQ amount is demanded. Okay, now if the rate from OR reduces to OR1, this will subsequently increase the demand from OQ to OQ1. Thus, more is demanded at lower price. After the completion of demand, the next factor which we have is supply of foreign exchange. Now, foreign currencies enter a country through export of goods and services, capital inflow, unilateral receipts, and altogether generate supply of foreign exchange in the domestic exchange market. Some of the important factors now that generate supply for foreign exchange are: number one, export of goods. Merchandise or goods exports constitute a major source of supply of foreign exchange. Supply of foreign exchange is influenced by the volume of exports and the prices of the exported goods. The elasticity of demand for and supply of a country's export significantly influences the foreign exchange earned from export. If the demand for a country's major export is relatively inelastic in foreign countries, then the supply of foreign exchange from those merchandise exports will be large. Example, oil exporting countries. If demand for export is relatively elastic, then with the fall in the price of export, there will be significant rise in foreign exchange earning and supply of foreign exchange in the country will be large. The next factor which influences the supply of foreign exchange is export of services. Now, with increase in trade in services, many countries have been earning large part of their foreign exchanges from this source. India is a significant example in this regard. Exports of services are a major factor generating supply of foreign exchange in the exchange markets. The next point is unilateral receipt. These include receipts from one country to another without corresponding sale of any goods, services or asset. These include basically donations, gift, aid received by the resident and the government, as well as receipts of repatriations of income like profit, dividend and interest from abroad, and remittance sent by nationals working in foreign countries. The next factor that influences the supply of foreign exchange is the import of capital. Capital inflows into a country generates supply of foreign exchange. Such inflow takes due to external borrowings, foreign direct investment and foreign portfolio investment. Such inflow takes due to external borrowings, Such inflows takes due to external borrowing, foreign direct investment and foreign portfolio investment. There has been significant increase in foreign capital flow from developed to emerging economies in the process of current phase of globalization. Such movement of capital causes frequent changes in the exchange rate. Import of capital is highly influenced by government policy. Okay, the next is future expectation. Just like demand for foreign exchange, supply of foreign exchange is also influenced by future expectations. When speculators begin to sell foreign currency in order to make profits, the supply of foreign exchange rises, lowering the value of foreign currency. Thus, speculation is motivated by future price expectation. Now, the total supply of foreign exchange is directly related to its price, that is the exchange rate. This can be understood with the help of the following diagram. The x-axis consists of supply of foreign exchange, whereas the y-axis represents the foreign exchange rate. Now, the supply from all these sources add up to aggregate supply of foreign exchange. The total supply, like the supply of any other commodity, is directly related to its price, that is the foreign exchange rate. The diagram above shows the relationship between the rate of foreign exchange and its supply. The supply curve of foreign exchange, like any other supply curve, slopes upward. Now, to sum up, foreign exchange is demanded basically for import of goods, for importing of services, unilateral payment, export of capital and for future expectation. Whereas the supply of foreign exchange is done for export of goods, export of services, unilateral receipts, import of capital and for future expectation. Okay, now the next thing what we need to go through is the determination of equilibrium exchange rate created by demand and supply. So as you can see from the figure, the x-axis represents the demand and supply of foreign exchange, whereas the exchange rate is on the y-axis. Now in the figure, the equilibrium rate is determined at point E, where the demand and supply curve of foreign exchange intersect. OR is the equilibrium exchange rate when the demand for foreign exchange and the supply is equal. OR1 and OR2 are not equilibrium exchange rate. At OR2, demand is more than supply, that is R2M is more than R2N. Similarly, at OR1, supply is more than demand, that is R1Q is more than R1P. Exchange rate R1 and R2 are not stable or equilibrium exchange rate. At the rate of R1 and R2 exchange rate, there will be pressure on the prevailing rate to move towards the equilibrium rate, that is towards point E, and E is that point where demand and supply intersect, and that is nothing but the point at which the exchange rate has been determined. Now, from the above analysis, it is understood that the exchange rate, like any other price, is determined by demand and supply force in the foreign exchange market. Any change in demand and supply will result in a change in the exchange rate. The exchange rate determined by the market forces would change as these factors changes in the market. The primary price maker buys or sells the currency in the market, and the rate continuously changes in a free market depending on demand and supply. With this, we can conclude, or with this, various factors that determine the foreign exchange rate comes to an end.
Okay, this sums up our first part of the second module. But before putting an end to this video lecture, we will have one MCQ exercise. So let us see which questions are there based on the first part of the second module. Okay, 3 MCQs are given. Number 1, the terms of trade are the ratios of export prices to import prices of a country that affects the dash. Options are bills of payment, balance of parity, balance of profit, and balance of payment. The second is LIBOR stands for number 1, London Interbank Offer Rate, London Internal Offer Rate, London Interbank Open Rate, and last is the London International Offer Rate. The third one is dash is a stock market where currency of other countries are purchased or sold. The options are A, Nasdaq, B, Forex, C is BSE, and D is NSE. Okay, read the question 1 carefully. Okay, try to interpret the correct answer for the first 3 MCQs. I'll give you a couple of minutes to figure out the answers, and then we will discuss the answers. Okay, let us discuss the correct answer for the first three MCQs. The first answer, I'll just get the pointer on. Yeah. The terms of trade are the ratios of export prices to import prices of a country that affects the first answer is balance of payment. Second, LIBOR stand for London Interbank Offer Rate. And the third one was Dash is a stock market where currency of other countries are purchased or sold. The correct answer for that is Forex. I hope everyone have got the first three answers right. We'll jump on to the next MCQ exercise. Okay. The next three MCQs are given as follows. First, the capital inflow into a country generates dash of foreign exchange. The options are supply, undervaluation, demand, or overvaluation. Next, by dash we mean covering of a foreign exchange risk arising out of the changes in the exchange rate. The options are hedging, hoarding, clearing, and forwarding. And last, dash guards the interests of both exporters as well as importers against any changes in the exchange rate. The options are hedging, hoarding, clearing, and forwarding. Again, read the question once carefully. I'll give you a couple of minutes to figure out the correct answer, and thereafter we will discuss the answers. Okay, now let us discuss the answers. First, the capital inflow into a country generates dash of foreign exchange? The answer is supply. By dash we means covering of a foreign exchange risk arising out of the changes in exchange rates. The answer for that is hedging. By hedging we means covering of a foreign exchange risk arising out of the changes in the exchange rate. And the next one, dash guards the interests of both exporter as well as importers against any changes in the exchange rate. Again, changes in the exchange rate, it is hedging. So I hope everyone have got these three answers right. Now we move on to the last MCQ exercise. Again, there are three questions. Number one, a country with a large debt will get less foreign investment, which can lead to dash. Options are deflation, inflation, depreciation, and devaluation. The eighth one, dash act as a middleman between the price makers. The options are agent, brokers, negotiators, and dealers. And the last one, the retail client deals through dash and authorized agents. The options are central bank, commercial bank, World Bank, and financial bank. Again, I'll give you all a couple of minutes to figure out the answers and then we will discuss the answers. Okay, let us discuss the correct answers for them. First, a country with a large debt will get less foreign investment, which can lead to inflation. The correct answer is inflation. Dash act as middlemen between the price makers. Answer is the broker. The last one is the retail client deal through dash and the authorized agent. So the retail client will always deal through commercial banks. So with this, we have completed the MCQ exercise based on the first part of the second module. With this, we can say that the first part of the second module comes to an end. Okay, I hope everyone understood whatever we have taken apart in this particular video. If you all have any queries, you all can email me your queries, or you all can even WhatsApp me on the given numbers. If you all have any doubt, you all can contact me. With this, we will conclude our first part of the second module. Thank you.